in 2010. We've posted our 2011 webinar schedule on LLIS.com, so please visit our website and register soon. Today's presentation will last about 50 minutes, allowing about 10 minutes for Q&A. This webinar is being recorded and will be posted to our website within a week. As a reminder, you will earn 1 CFP-CE for attending all of today's webinar. Since this is an encore performance of our April webinar, if you receive CE credits then, you are ineligible for CE credits again for this webinar. We will provide proof of your attendance to the CFP board and will email you a certificate of completion. This process can take up to a month. Please note that you must be logged into the webinar for at least 50 minutes to receive this credit per CFP board policy. We welcome your questions and participation. However, because of the large number of attendees, please note that all lines are muted. If you have questions during the presentation, you can type them into the question box on your screen. Jerry will be addressing these questions midway through the presentation at slide 18. Then at the end of the presentation, we will open the phone lines for more questions. You will need to enter your audio PIN number if you want to ask voice questions, or if you are using the speakers on your computer, you'll need to have a microphone hooked up. Now on to your presenter. Today presenting for you is Jerry Skapyak. Jerry's almost 20 years in this industry, analyzing, studying, and researching annuity products have made him the go-to guy for advisors with clients seeking to ensure they don't outlive their savings. He is licensed for life and health insurance products, and, even more important than his product knowledge, Jerry knows people. He is skilled at assessing clients' needs and the benefits most important to them, then tailoring the right product to fit their unique circumstances. Now presenting long-term care and life annuities, the hybrids, is Jerry Skapyak.
Hello, everybody. I hope everybody's enjoying the holiday season so far. But there we go. I want to cover a couple items today. Our goals for today is I want to make sure everybody has an understanding what the Pension Protection Act did for hybrid products, how these hybrid products work, and finally, what type of client should consider a hybrid product. Now, the hybrids are vehicles that are use both electricity and gas. Hybrid insurance products, like the Prius, have been around a long time, but they have been revamped and renewed to be more of what consumers are looking for today. The hybrids we're going to talk about today combine life and long-term care insurance or annuities and long-term care insurance. And when you consider that, 69% of people age 65 today will need long-term care at some point in their lives, and that the national average for 1 year of care in a nursing home is $71,000, and that could be substantially higher depending on what part of the country you live in. The question is, how are clients going to pay for this? How are they going to pay the $71,000 a year? Now, there's 5 ways you can fund for long-term care. You can self-fund. You can pay the cost out of your savings. You can self-fund and buy a basic short benefit period long-term care insurance. So let's say that the client has, for example, real estate. They have a lot of assets, but they're not liquid. Buying a basic short benefit period long-term care policy can cover that gap until they are able to liquidate real estate assets or any type of permanent asset that's hard to sell to pay for that coverage. They could self-fund and buy long-term care insurance with a long elimination period. Let's say they do have some assets and they can fund the long-term care for a period of time themselves, but over the long run, they would not be able to afford the long-term care that they need. So by using a long elimination period, you can cover that. Or you can buy long-term care insurance to cover most or all of their long-term care costs. This is for clients that they've saved for retirement, but if they were to need long-term care, it could quickly deplete all their assets they have. And finally, they can buy a life or an annuity hybrid product that allows prepayment of the death benefit if they need long-term care services. And we're going to cover that in more detail throughout this presentation. So let's cover a couple items first. We call them hybrids. You may hear them also referred in the market as an ABC product or asset-based care product, or also referred to as linked benefit products. But throughout this presentation today, I'm going to refer to them as hybrid products. Hybrid annuities and life insurance, they do double duty, those dollars. And you're going to hear me refer to this, and if you get nothing else out of this webinar, I want you to remember by using the same dollars that a client already has, where they may just have it sitting in a life insurance product or just sitting in an annuity, by moving it to a hybrid product, those same dollars can now do double duty. They can provide a death benefit and a long-term care benefit, or they can be sitting in an annuity that they could annuitize at any point in the future, but if, God forbid, they need long-term care, those same dollars can provide that. And also, these hybrid products answer the #1 objection to long-term care insurance. I don't want to pay for something that I may never use. All right, so let's talk about the Pension Act of 2006, or it's referred to most commonly as the PPA. Common misconceptions that the PPA did. You cannot withdraw money out of a life insurance or annuity to pay for long-term care insurance on a tax-free basis. You cannot just withdraw money out of those products to pay for your long-term care insurance. Also, you cannot use qualified funds to fund a hybrid product. You can only use non-qualified funds. So what options did the PPA create? Well, here are two non-hybrid options. First, you can use a traditional single premium immediate annuity to fund long-term care insurance. Or you could use a traditional single premium deferred annuity to fund long-term care insurance. So let's take a look at what happened with the immediate annuity to pay for long-term care insurance premiums. Before January 1st of this year, all income from an immediate annuity was treated as part gain and part return of the premium if it was used to pay for long-term care premiums. So just like a traditional immediate annuity that's used just for income in a client, if that same annuity was used to pay for a long-term care insurance premium, it was still taxed the same. You got part gain and part return of premium in each payment. The part that is gain is taxable to the client. After January 1st of 2010, what changed was the income that is assigned to a long-term care insurance premium from an immediate annuity or SPDA or SPIA is tax-free, or otherwise is taxable part of the payout. They don't have to pay taxes on the payments or the payout that is generated from that immediate annuity. And what this does is nets a higher net after-tax payment to the client. But a problem is the tracking and reporting of this. Most companies are not set up when they have an immediate annuity and it's going to be used to pay for a long-term care insurance premium. Their systems are not capable of tracking that and not producing that 1099 that's going to show that the client had some taxable income. So let's take a look here at an example.